Today we're talking about holding companies and how they can potentially save you millions of dollars. If you're a Canadian entrepreneur, then your number one expense is taxes. You should be doing everything possible to reduce that expense, and setting up a holding company is a great way to do that. Today I'm going to break down exactly what a holding company is, who should be using it, what the benefits are, and then walk through an advanced tax example so you can actually understand how much more money you could be saving by using this holding company structure. With that said, let's get into it and understand what a holding company is. Let's break down the holding company. This is really a simple entity that owns part of or all of your operational company. Its only purpose is to hold various different assets and maybe to do something like investing. You're not doing operations inside of this company, it just holds a lot of different assets. It may own part of your operational company or multiple operational companies, and because of that stake in ownership, it's entitled to receive dividends tax-free from those companies or that company. That means that when your operational company makes a ton of money, rather than having to pay it to yourself personally through something like a dividend, a bonus, or a salary, where you're going to pay a very high personal tax on that, instead you can transfer the money to the holding company tax-free. Now, a larger amount of money can be invested in the holding company, and you can take it out slowly at better marginal tax rates later on. A lot of people treat their holding company like a pension or a retirement fund, and they'll simply take small amounts of money out of the holding company when they need it, rather than taking huge amounts of money out of the operational company all at once. This way, you're paying small marginal tax rates over a longer period of time, you have a higher principal amount of money that can grow faster, and we're going to go through an example where I actually show you the math and you can see how much more money you can accumulate by using the holding company. Now that's the overall strategy, but the holding company has a lot of other advantages that you'll want to be aware of. Now the first reason is liability. The holding company acts as a shield for the assets that it holds. Simply put, if you're operating a company in Canada, that has inherent liability. If you do something wrong, you could be sued, maybe you go bankrupt, who knows what's going to happen. Any assets inside of that company that's performing the operations could be up for grabs and are not protected. So instead of leaving them there, we want to move them to the holding company where they are shielded, because the holding company isn't involved in any of those operations, and therefore we can't take any of those assets. It acts as a shield, it's good liability, and you definitely don't want to be holding, for example, tons of cash or investments in your main operational entity, because that's just very, very risky. Now, the next reason you would want a holding company is to ensure that your operational company qualifies for the lifetime capital gains tax exemption. This is an amount of about $1.1 million that you can receive tax-free when you sell qualifying shares of a small business. This is particularly important if you're doing something like departing the country, which I've done recently. I've left the Canadian tax system, or selling your business eventually down the line. Now, the key word here is qualifying, when you sell a qualifying small business. Now, in order for the business to qualify, most of the assets being used within it have to be used for business activities. That means that if you have a huge amount of investments, cash, real estate, whatever it is that you own inside of the company, and that's not used in the main business activities, that could actually force your company not to qualify and means you cannot receive this exemption. I recommend that you look this up or consult with an accountant, but this is a very important exemption that you'll want to take advantage of, and it's very easy to not qualify by holding too many assets in your operational company. Now, a few more reasons you might want a holding company is that it makes it easier when it comes to acquisitions later down the line. It also makes your company more easy to sell because you don't need to worry about distributing a ton of assets that you might be holding. It also gives you access to split income opportunities where you can pay money more easily to something like your kids or your wife, especially if you're not the primary owner of this operational company. Beyond that, there's a lot of other reasons you might want to set it up, but generally speaking, it's going to be a huge tax advantage to you, especially if you're an entrepreneur making a significant amount of money. It's worth noting that it does cost a bit of money to maintain this structure. In my case, it's between $5,000 to $10,000 per year, so you need to be making a fair amount of money for this to make sense, and it can also be difficult to unwind this corporation if you're doing something like exiting the country, which I've done recently. Regardless, let's now go to an example where we can see the difference in taxes and wealth generation by having a holding company versus not having a holding company. So we're going to dive into this example here, but I do quickly want to mention that I am not a professional accountant or a lawyer. I know a lot about this stuff because I've paid those guys tens, if not hundreds of thousands of dollars at this point to do all of this for me. And if you actually want assistance with this, which I would highly recommend, then you can send me an email. I'll leave a link in the description, and I can refer you to the exact accountants and lawyers that set all of this up for me. They're experts in Canadian law and Canadian accounting and taxes. They've saved me hundreds of thousands of dollars, and they can likely do the same for you if you want a structure similar to this. Anyways, let's get into the example. Okay, so I'm on the computer now and I'm going to walk you through this spreadsheet that I've made. Now, by no means is this perfect. Do not take this as tax advice, and please always consult an accountant, but this will show you the high level picture and you can understand how much more money you can have when you actually use the holding company. So in scenario 1 here, we're looking at all personal income. What I mean by that is we just take whatever the profit of the business is and we pay that to ourselves as a salary or a bonus. Now in this situation, we have $500,000 of personal income. That gives us an average tax rate of about 45% and a marginal tax rate of 53.53% if we live in Ontario. That means that we're paying about $225,000 in taxes and we have $274,000 remaining. Now all of this money is personal income. We can do whatever we want with it. We've already paid tax on it. Now let's look at scenario 2, where we split this with business income and we use the holding company. Now what I mean by this is we're going to pay ourselves a small salary. We're then going to retain the remaining amount inside of the company and dividend it to the holding company. Now for practical purposes here, it doesn't matter if we were to hold this in the operational company or a separate holding company. The idea is just to show you what happens when you retain money inside of the company rather than paying it all to yourself personally, so you can understand this strategy. So you can see here that we had business revenue of $500,000. Let's imagine we've taken all the expenses out already, and this is what we're left with. We have a salary expense of $150,000. That's how much we're going to pay ourselves personally so that we can survive and we can have some money. And we're left with a business profit of $350,000. Now the corporate tax rate for small business income, which this would qualify for, is 12.2% in Ontario. It's lower in a few different provinces. This is a very advantageous tax rate and the reason why this strategy actually works. That means in the corporation, we're going to be left with $42,700 in taxes that we need to pay, giving us $307,000 in retained earnings that we're keeping in the business. Now, this amount of money can be paid as a dividend to our holding company, where we can then invest it later on, which we're going to look at on the next sheet. Now, from the personal income side, we pay ourselves $150K. This gives us a much more favorable average tax rate of 28.5% and a marginal tax rate of 43%. So when we look at our total taxes paid here, we've only paid $85,000 in tax, and we have a remaining $414,000 that we can invest and use as we please. So just look at the two examples, right? We paid ourselves all personal income. That means we had to pay $225,000 immediately in tax. Whereas here, when we split between the corporation and personal and paid ourselves still a very good salary, we're remaining with $414,000. Keep in mind, $300,000 of this is not accessible to us personally until we take it out later on, but I'm going to show you exactly what happens when we do that. Alright, so now we're moving on to the next sheet, where I'm going to show you exactly what would happen to this amount of money if we invested it and allowed it to compound over 30 years. Now we're going to look at two scenarios. The first scenario is when we paid all of ourselves that money personally, and the second scenario is when we split the income and kept some of it in the company and paid some of it as a salary. I want to show you exactly what happens here. So when we look at scenario 1, you can see that we start with approximately $275,000. Let's say we get an average annual return of 7%, conservative, but that's fine. You can see how the money grows from year 5, 10, 20, and 30. Now this is very simple. All of this money we have access to personally. Maybe we have some in a TFSA, which is a tax-free account, and maybe we have some in just a regular stockbroker account where we will have to pay a capital gains tax rate. Now we're going to neglect that capital gains tax rate for right now, and you'll see why, because it's going to cancel out with the other personal tax or the other personal income that we'll look at in a second. Anyways, that gives us a net gain of about $1.81 million from that original $275K over 30 years. Very simple example, you've probably seen this before. Now let's look at what happens when we use this with the split income strategy. So some of the money we keep in the holding company or in some corporation, and some of the money we pay ourselves as a salary. So here you can see that we're left with $107,000 personally from the $150K salary that we paid ourselves in scenario 2. So we can invest that $107,000 personally, and you can see that that will turn into $815,000 by the end of 30 years. This is our personal money that we can access, we can do whatever we want with. We've already paid taxes on it. Now again, we will need to pay some capital gains tax on that, but since we're not going to consider it for example 1, we won't consider it for example 2, and you'll see that it will kind of even out. Now that gives us a net gain personally of $708,000. But here comes the interesting part where we look at the business. Now in the business, we were able to retain $307,000. Obviously that added to the 107 gives us a larger capital or a larger principal to invest, which means we're going to end up with a lot more money. So when we look here, we have year 5, year 10, 20, 30, and in the business, we're left with about $2.3 million. When we add that together, you can see that we have $3.1 million at the end of 30 years compared to approximately 2.1. So you can see here in example 1, we had a gain of $1.8 million, and in example 2, a gain of $2.7 million. So significantly more when we use this split income strategy. Now the issue with this strategy is that a lot of this money is locked up in our company. If we want to access it, we're going to need to pay some kind of personal tax on it. So let me walk you through exactly what happens when we start paying those taxes and see if we still come out ahead when we eventually access the money from our corporation. Keep in mind, the way I'm going to show you how to do this is not the most tax advantage, but it's just meant to illustrate the point that this is a superior strategy. So let's go down to the summary tab where I've done all of my advanced math here. So you can see that in the second scenario example, we retain a personal value of $815,000, money that we can access from that original 100K invested. We then have a business value of $2.3 million approximately, and a gain in the business of about $2 million. That's the investment gain. Now on that gain, we're going to have to pay a capital gains tax rate. This will be approximately 25%, and that means we're going to pay about $500,000 in tax on that capital gain. But what this also means is that since we had a capital gain of approximately $2 million, we have now something known as a capital dividend account of approximately $1 million. Now this account is a way that we can pay ourselves dividends from the company tax-free. So half of whatever the capital gain is that you have goes into the capital dividend account, which can then be distributed to shareholders completely tax-free. So $1 million or whatever the amount is here, we can receive tax-free, and then we need to go and strip the rest of the money out of our corporation. So now we have a personal value plus our tax-free dividends of about $1.831 million because we paid ourselves the $1 million and we had the original $815K. That leaves us with about $800,000, the remaining business value, which is now money inside of the company that we'll want to access personally. Now really, what we should do is just slowly take this out over time so that we pay the lowest marginal tax rates possible, but let's say you just wanted it all at once. Well, if that's the case, you're going to pay a dividend tax rate of approximately 38%, which means you're going to have to pay about $300,000 in tax to extract this money out of the company. You'll then receive about $500,000, which means your total personal value, money that you have in your personal account that you can access, that you can use after this strategy, is about $2.3 million. Now, if we go up, you can see that the amount that we had before was about $2,088,000, and here we're now left with more, $2.33 million, so about $250,000 more than in scenario 1 by using this holding company strategy. So yes, it is a lot more complicated, there's more taxes that we need to pay, but even after paying all of those taxes and taking out money in the worst possible way, we're still up a significant amount, and obviously the more money that we were to invest in our holding company and the more years we were to do this for, the more money that we would have at the end. Again, this comes from having a larger principal amount and not having to prepay the personal tax. The key to this strategy is that rather than having your money stripped personally when you pay it to yourselves at really high marginal tax rates, we take advantage of the very low corporate tax rates on small business income and then allow ourselves to grow a larger portfolio, which we then access later on. We're deferring the tax much further into the future, and eventually we will actually pay less tax if we take this out in a tax efficient manner, as I've showed you right here. So there you go, that's going to wrap up this video. I hope you found this helpful, and if you want a link to this Excel sheet, I'll leave it in the description so you can check it out.